Everyone's looking at housing and saying it's too high priced and labor costs too much and the materials are too much and the land is too much, and they all sit there and they say, isn't that terrible? What are they going to do about it?
That was Pierre Rinfret of Rinfret Boston, appearing on Wall Street Week way back in 1976. And it looks like we're back to some version of that world again, with higher prices and higher input costs for housing. But a slowing economy, and Fed Chair Jay Powell told us this week, a slowing housing market as well. Still with us are Kristina Hooper of Invesco and Jim McDonald of Northern Trust. Jim, this is exactly where you left us off on the housing market. We heard Jay Powell this week say, yes, it is slowing. We could even have housing prices go down, at least in some markets. How big a drag, potentially, even a danger for the economy, is the housing market?
I think the danger is more from the volume standpoint than it is from the price standpoint. If you think about housing today, it's about 4.5% of the economy. It got to 6.5% during the bubble. So we're nowhere close to that level of an impact. And what I think will provide some cushion to the downside on prices is that inventory is incredibly low. Vacancies are very low. So while the jump in mortgage rates really hurts affordability, there is just a mismatch between demand and supply that I think will put some downside underneath prices.
And I think it's going to take a long time to work through that and get to the point where supply meets demand, especially given all the supply chain issues we're currently experiencing. It's just not an environment in which we're going to see a lot of homes built, especially first-time home buyers' homes.
So, Kristina, give us a little investment advice here, right? That's what we really want. We're saying we're clearly going into a downturn. We don't know how bad it'll be. At the same time, we know we'll come out of it at some point. As an investor, what do I do in the short, intermediate term to make sure I'm protected? But as important, perhaps more important, what do I do to position myself to come out of that downturn stronger than ever?
Well, I think it's a great question. I think it's great to look at it essentially in two phases, because what we're experiencing right now is this significant drop in the stock market and actually a significant drop for some fixed income. And what has driven that is expectations about an economic slowdown, whether or not it's an actual recession, a slowdown. We know that markets tend to signal economic events before they happen. So I think that before long, certainly before the end of the year, we'll start to see a stock market recovery in anticipation of an economic recovery next year. And so I think we have to keep that in mind. Too often investors have gotten spooked. Look at the global financial crisis, how many people got out towards the bottom, locked in losses. I think it's critical to be forward-looking and think of this time frame as actually a time to start looking for opportunities, to start dollar cost averaging. I think you want, over the shorter term, to have a pretty neutral stance when it comes to risk, but start to look and start to allocate for that recovery, because the recovery, I think, is going to be longer lived than the downturn.
Jim, right now, a lot of people are talking about high yield because of the returns you're getting on high yield right now. What, over 7%, maybe 8%, something like that? Is that a place we want to be right now?
I think it is, and if you want to be defensive in this environment, high yield bonds provide about 1/3 of the downside risk that equities do. And an important distinction is, do you think of high yield as a fixed income alternative or a risk asset alternative? And we think of it as a risk asset alternative. So if we go into recession, high yield bonds on average have declined just 4.5% during the past 6 recessions, whereas US equities are down over 12%. And you're getting a current yield to worst of roughly 8.5%. So when people say, how can you buy high yield bonds if we're going into a recession? The answer is, if you're trading out of equities into them, it's a less offensive position, but you don't want to trade out of investment grade bonds into high yield if you expect we're going to go into a recession, because investment grade bonds have historically done very well in that environment.
But I think when Jim talks about U.S. equities, he's talking about a broad basket. And I think what we need to do in the shorter term is be more defensive in our equity exposure. So in U.S. equities, having more exposure to what I would call defensives and secular growth, including healthcare and technology. And so that could be actually, after especially significant losses in technology, could provide a slightly different risk-reward profile than an overall general U.S. stock market basket.
So, Jim, what about that? Defensives in equities?
Yeah, so the one nuance I would add to that is that we still like the natural resources sector, commodities oriented, energy stocks, for example. They're a nice hedge against our number one risk case, which is sticky inflation. We don't know when these supply chain problems are going to get fixed. You keep hearing about more issues in the energy patch. For example, what's going on in the Ukraine and the big steel production facility in Mariupol that is probably shut down. And so they're not able to provide the steel tubing that goes into oil exploration. All of those things tell us we want to have some hedge in energy. And we do like technology. That's a recent upgrade for us for the secular growth reasons. We expect technology to grow its share of GDP over the next decade by roughly double.
Well, now that's really interesting because there's sort of the bloom's been off the rose of a lot of technology recently after a really great run, sort of come off again. Where are you in technology, Kristina?
I'm very positive on technology. Now, I think we need to be selective.
Yeah.
We want to stay away from what I would call spec tech, which was actually the first leg of technology to fall. But there are a lot of great names in that space, some of which look like very good buys right now, given where valuations are and given strong cash flow, just solid fundamentals in general.
Jim, you also, I know, have said that you like infrastructure investment. What does that look like?
So it's a global basket of companies that help provide the infrastructure to energy, to electricity generation, to transportation. They generally have got a very good ability to pass through inflation through price increases. They tend to have a much higher yield than the overall market. So it is a little bit more of a defensive way to keep some equity exposure, but also benefit from the inflationary trends that we've been experiencing.
And Kristina, what about the longer term trends? Again, coming out of whatever downturn there is here, what do you think is promising? Are we talking about things like green energy? What are we talking about?
So I certainly think there are a lot of different themes that are very exciting. Some are smaller than others. Green energy is certainly one of them. Cybersecurity is one of them. But I think I would take a step back and say the bigger picture is that we're returning to a more normal environment. And when I say more normal relative to longer term history. And so that suggests to me an environment in which there is more diversification offered by fixed income, higher yield offered by fixed income, but still adequate returns from stocks. We're going through an adjustment period right now. That's not fun, but I'm very excited about the future and what it holds for investors.
Jim, more normal certainly sounds pretty good to me right now. At the same time, how much of that depends upon the Fed not overreacting? Because some people say the Fed's had a really big say in the markets thus far. Getting back to neutral, fine, a little above neutral, fine. But if we're really going well above that to 4 or 5%, what is that going to do?
Yeah, so I would define overreacting a little differently. I would say that if they end up doing that, it's because inflation has proven to be more persistent, and so their action is actually justified. And that is not going to be a good circumstance for the market. If you think about bear markets, there really are three categories: an event-driven one, which is the least damaging. Secondly, you can have one that is more cyclical oriented, and then you could have one that's driven by a financial crisis where credit creation is impaled. If the Fed hikes rates too much, we're definitely going to go from what's an event-driven to a cyclical type of recovery. But if you look at the Fed stress test results over the last 24 hours, the banking system's in really good shape. So we are very unlikely to get into a structural bear market, which can be really damaging.